Okay, if you've opened literally any social media app this June 2026, you've almost certainly been hit by a wild claim just like this one. You know the type, influencers lounging around in fluffy housecoats, staring dead into the camera and telling you, often specifically targeting single mothers by the way, to take that $2,000 tax return and 10x it into 20 or 30 grand in just 6 months by buying AI stocks. I mean, it sounds absolutely incredible, right? And hey, if it's not some magic stock pick, it's a shiny new app. You'll see these so-called day traders standing on a beach somewhere telling you how they're pulling an easy 10% return just by betting on the news. Like literally betting on whether specific court documents will drop on a Tuesday. And they aggressively pitch this idea that, no, this isn't a casino, it's a truth machine, and you can get rich off your own general knowledge. Honestly, it's the ultimate modern financial illusion. But here is the sobering reality. -8%. Yeah. According to research tracking data right up to March 2026, -8% is the median return for retail traders using these gamified production platforms. So while a few professional arbitrage firms out there might be skimming the profits, the vast majority of regular, everyday people, they are just bleeding money. Welcome to today's Explainer. As we navigate the current landscape of June 2026, we have to admit, it is frankly a minefield for the everyday investor. We're seeing this totally unprecedented digital gamification colliding head-on with massive global economic shifts. So, to protect our wealth, let's cut through the noise and unpack exactly what is happening behind the headlines together. Here's our roadmap for today. We're going to examine the AI advice trap, the reality of prediction markets, some hidden cracks in private credit, and global economic shocks. And finally, we'll cover exactly how to protect your portfolio. Let's dive right in. Section 1. The AI advice trap, Silicon Valley's financial planners. Right now, we're seeing major tech platforms launching pilots to try and basically replace human financial planners, but there is a pretty massive catch. Just look at the stark contrast in legal protections here. A registered human fiduciary is legally bound to put your financial interests above their own. They literally have to understand the products they're selling you. But an AI chatbot, it has absolutely zero fiduciary duty. Plus, they have built-in conflicts of interest. For instance, OpenAI recently announced a paid partnership with Intuit. So think about it. If the AI recommends a specific tax tool, is it because it's actually the best fit for you? Or is it just because that company paid the platform for placement? And remember, AI language models are prediction engines. They are not judgment models. They are highly prone to hallucinations, which is just a fancy way of saying they confidently make things up. As my fellow creator, The Plain Bagel, pointed out recently, let's not forget that viral moment where ChatGPT adamantly insisted there are 0 letter E's in the word 17. Seriously, if it spells at a 5th grade level, maybe, just maybe, we shouldn't trust it with our life savings. Always, always scrutinize the output. All right, moving on to Section 2, prediction markets, a casino, gamified investing. Now, platforms like Polymarket and Kalshi have absolutely exploded recently, largely by using legal loopholes to avoid being classified as actual casinos. Now, the executives behind these platforms love to call them truth machines that offer vital economic forecasting data. Yet, check this out, 79% of Kalshi's volume is just sports betting. The marketing might lean hard into this idea of sophisticated financial hedging, but the reality on the ground is heavily concentrated in, well, degenerate, gamified sports wagering. So here is the absolutely crucial point. 84% of Polymarket users lose money. That is according to independent blockchain analysis. 84%. So why on earth are so many social media influencers pushing you to sign up? Well, it's because these platforms offer incredibly lucrative referral codes. When a TikToker gives you a code to skip the waitlist, they are literally getting a cut of your trading fees. It's basically financial nihilism packaged up as empowerment. Which brings us to Section 3, private credit's hidden cracks, the $2 trillion shadow market. Let's zoom out a bit to this opaque, loosely regulated space that swooped in to fill the gap after the 2008 bank regulations. And you guys, the cracks are absolutely starting to show. In June 2026, corporate default rates in the private credit space hit 9.2%. That is a huge jump, heavily fueled by this massive wall of debt maturities coming due, higher interest rates, and frankly, completely over-leveraged private software companies. We are talking about loans that were appraised at full value suddenly being written off to zero almost overnight when these borrowers declare bankruptcy. And because of these rising defaults, we're seeing a mad rush for the exits. Regular investors who were initially drawn into private credit retail funds by the shiny promise of high yields are suddenly finding their money trapped by what are called gated redemptions. Basically, major funds, from Blackstone to Blue Owl, have had to limit or completely halt withdrawals just to prevent a fire sale of their illiquid assets. It is a very stark reminder of the premium you pay for tying up your money in private, opaque markets. Now, Section 4, Navigating Global Economic Shocks, Macro Threats to Retail Wealth. Because it's not just about digital apps and shadow banking, right? National policies and geopolitical conflicts heavily dictate the reality of everyday wealth. Take the Canadian market, for example. The government is launching a $25 billion sovereign wealth fund, but uniquely, it's restricted to 100% domestic private infrastructure. That is a massive concentration risk, especially since similar global funds usually heavily diversify internationally. Add to this the serious economic headwinds of the Alberta separatism movement. Research is showing that non-tariff trade barriers from secession could cost the landlocked province $20 billion annually. That risks severe capital flight and currency instability that would impact the entire region's investment climate. And then, of course, we have rapid geopolitical shocks. Look at the recent Middle East escalations involving Iran. Within a matter of weeks, military strikes led to explicit threats of waterway blockades, which actually caused shipping companies to completely suspend transit. As a direct result of that, West Texas Intermediate crude shot up to nearly $90 a barrel. Now, you might be wondering, why such a massive global price spike from a regional conflict? Well, it's because 31% of the world's seaborne crude oil passes right through the Strait of Hormuz, alongside a third of global urea fertilizer and massive amounts of liquefied natural gas. When that critical choke point closes, global supply chains panic, inflation spikes, and the everyday consumer pays the price at the pump and the grocery store. This is exactly why geopolitical instability matters directly to your retirement account. All right, Section 5, Protecting Your Wealth Today, the Fiduciary Framework. So, with AI hallucinations, casinos masquerading as investments, private credit defaults, and macro shocks, what do we actually do? Well, here is your practical checklist to insulate your portfolio right now in 2026. Step 1, scrutinize all AI financial advice. It's a tool, it's not a certified expert, so always verify the math yourself. Step 2, avoid those gamified prediction apps. Please do not let influencers trade away your life savings just so they can collect referral fees. Step 3, ensure your funds actually have liquidity. If a private credit fund can gate your redemptions, make absolutely sure you don't need that cash anytime soon. And finally, Step 4, diversify globally. Do not let your hard-earned wealth be concentrated in a single domestic market or a single volatile asset. Which leaves us with this final, somewhat provocative thought to mull over today. Has the gamification of finance gone too far? When our financial apps start looking and feeling exactly like slot machines and AI chatbots are treating our life savings like some kind of text experiment, we have got to stay vigilant. Focus on the fundamentals, tune out those flashy online promises, and guard your wealth. Thank you so much for joining me for this explainer. Stay safe out there and keep learning.